Hi there, it's Corey here, CEO and founder at Verse Wealth. And today I'm joined by a special guest, that is David Bassanese, one of the most notable economists in Australia and the chief economist at BetaShares. David, thank you for joining us.
Great to be with you again.
Great, thank you for having us. Now, today we are going to have a casual chat about what's been happening on investment markets in recent times, as well as the broader economy. So without further ado, I think we dive into it. I've got a few questions for you, and I'll start with what has been happening in recent times on investment markets. David.
I think probably the single, obviously there's been a bit of an uptick in volatility. So equity markets have had a bit of a pullback in the last few weeks. So the US market at its low point, I think was off around about 5 to 7%, depending on the particular index. So we've had a pullback, and there's been a few things swirling around. Obviously, concerns about China debt situation, the Evergrande, a major property developer having trouble paying off its debt. Some problems with in the US, the need to raise the debt ceiling. I won't go into the details, but just more squabbles in Washington and potentially, problems that might cause a government shutdown. And even potentially the government defaulting on its debt if they don't, increase the debt ceiling in the US. But I guess the key driver has been a hawkish tilt, if you like, from the US Federal Reserve, basically signaling they're going to reduce their bond purchases from November. They've been buying up to 120 odd billion worth of bonds every month. And also, more talk of the Fed eventually raising interest rates later next year. So we've seen bond yields go up, which has put some pressure on equity valuations in the last few weeks. And that's really ultimately, I think, the key issue at the moment is, do bond yields keep rising, and does that put pressure on the equity market?
Sure. And in terms of the US Fed slowing down that purchase of bonds, bond purchases, what's driving that and that change for them?
Oh, look, the economy really, it's an emergency measure. They've been buying $120 billion worth of bonds every month since COVID struck last year. They're buying, they own a big chunk of the bond market today. Interest rates there are still at zero. But the economy is recovering. They're getting over COVID. The unemployment rates dropped back down to, the low 5% levels. Inflation has picked up. We think it is a short run issue, but nonetheless, inflation has picked up in the US. So basically, it's time to, take the punch bowl away from the party, so to speak, and really slowly start doing that. And so that's, I think that's ultimately, what's happening at the moment. They're just talking about unwinding some of that stimulus that they put in place to deal with COVID. Yeah.
Okay. Well said. And that's perhaps in part why we saw a bit of nervousness and some volatility in markets in kind of August and up towards late September. I know our market was down about 5% through that period, but has kind of incrementally risen a little bit since then. So I guess one of the key factors driving markets at the moment, and since the lows of the COVID downturn in March last year, is low interest rates. Can you maybe speak to that and what impact those historically low rates here and overseas are having on share markets?
Yeah, well, first and foremost, I should point, what has really driven the market since, say, the middle of last year has been earnings. So, let's not forget, we've had a V-shaped recovery in global growth and in corporate earnings. And so that has been really driving the market since the middle of last year's corporate earnings. Now, interest rates have stayed low, and that's meant that equity valuations have been able to stay high. So the US market, even our market, at one point last year was trading at over 20 times forward earnings, or 20 times earnings, because the market was looking through the earnings weakness and expecting markets to recover. And the market was allowed to stay at those high valuations because interest rates, as you point out, were so low. Now, the issue now is as interest rates renormalize, and we can, just what is normal, but as interest rates basically edge back up again, that's putting downward pressure on valuation. So that's the tug of war that's going on in the markets at the moment. Corporate earnings are likely to remain pretty good, and that'll help push markets along. But as interest rates go up, and again, I stress, I think they'll go up, but gradually, that's going to put the PE ratios, the market's valuations going down. And so the net outcome should still be markets going up, but it may not be smooth because of this tug of war. Earnings going up, but valuations coming down somewhat as interest rates come up, and that's the tensions in the markets at the moment.
I mean, our rates aren't likely to rise for quite a while. The Reserve Bank has said they want to see, low unemployment, and they want to see wage growth, which we haven't seen for some time. And I think at this stage, that's forecast to be perhaps it's still a couple of years away until we see our cash rate start to rise. But of course, things change along the way. Now, an extension of what you're saying in terms of maybe markets not going up in a straight line. I mean, we've seen a phenomenal rise on markets and rebound off the COVID crash we had last year. We had our market, US market, fall 35% in about 30 days between March and April. And that was the steepest downturn, not the biggest, but the steepest downturn we've seen on markets. And since then, we've seen the All Ordinary, so our 500 largest companies on the ASX, rise by about 60% as of today. And the S&P 500, so the 500 largest in the US, rise by around 95%. So, should we be concerned about that? Should our clients be concerned about that? Should we be expecting a pullback? What are your views there, David?
Look, I don't think the market, I wouldn't be concerned about the speed of the rise. As you said, it was a very sharp drop. And we've had basically we've had almost the best case scenario in terms of economic recovery from COVID. So the speed of that rebound in the markets in and of itself, I don't think is a worry. I think, will we get a pullback? I mean, when I think about the risks in the equity market, there's two things to worry. A is a correction, something of the order of up to around about a 10%. When the markets fall by at least 10%, it's called a correction. When they fall by more than 20%, it's called a bear market. Now, historically, to get a bigger than 20% decline, you need to get a US recession. Typically, that's what causes a big decline in the market. That risk, I think, is still very low for at least a few more years. So we're in an early stages of the new cycle. So the risk of a greater than 20% decline in the markets, I think, is still quite low. The risk of a correction, nonetheless, that's still around. And again, historically, one of the drivers of a correction in the markets, and particularly at this stage of the cycle, is when central banks start to take away the punch bowl. From having slash rates during a recession. And the US did have a recession last year, albeit a very short one. And with as I said, valuations are looking a little bit still stretched relative to earnings. That's where you do get that risk of a correction. So we may well be in the throes of it at the moment, but probably at some point between now and the next 18 months, as the Fed start to eventually raise interest rates, you will get that. I suspect you will get that correction, but as I say, it's the price of admission when you invest in the equity market, and it doesn't always go up in a smooth way.
Absolutely, you said that really well. I mean, if you're a client watching this, you'll know that's the common conversations you have with your advisor, is that volatility is a natural part of markets, and volatility doesn't matter until you step into it and do something with it, which typically doesn't serve you really well. So if we do see a correction in the short term of over 10%, as you said, it's not a reason to change a long-term investment strategy. It's not a reason to rethink the decisions that you'd previously made from a portfolio investment perspective. It's part and parcel of long-term investing. And, a lot of the things you were talking about at the top of our chat around, the Chinese developer and the US debt ceiling and so on. I mean, you could kind of lump all these things into a basket called noise, and they kind of, in the short term, will buffet markets and create volatility and uncertainty and reasons to be cautious or panic or sell. But there's always those reasons if you're looking for them. And really separating yourself from that bucket of noise, makes in the process of investing much easier. And of course, that's what we're here for, and your advisors are here to help you with as well. So I perhaps want to leave share markets there. I think we've covered enough ground. Thank you, David. I just want to segue quickly to property markets before we wrap up. So the talk of the town, so to speak, in this country, Aussies love their property. Prices have been rising really significantly in the last 12 months. We've seen some really record price growth in different quarters and markets and different months. And these low rates that we've got are continuing to spur price growth. There's been some talk in recent weeks about the regulator APRA stepping in and maybe tightening up credit policy or lending standards. What are your views on that? Do you see that as a possibility of happening? And if so, what effect do you see that perhaps having?
Yeah, I've actually really since the start of this year have been anticipating that APRA would eventually impose, what's called macroprudential controls, basically some restrictions on banks to like rein in their lending. And I think what we've seen is they're insisting that banks at the moment have a buffer, so making sure that people that borrow could afford to pay off their mortgage, even if mortgage rates were 3% higher than what they currently are. So they're enforcing a stricter buffer. And that's because I think APRA are concerned that there's been some evidence of people taking out very big mortgages relative to their income, and they're just worried that if they are relying on very low interest rates continuing, they've got to allow for the fact that even in Australia rates will eventually go up. So that is happening. And really, why is it happening? It's happening because, as you've said earlier, the RBA is still promising not to raise rates for several years. They're targeting they want to get a very tight labour market. They want to get wages up. They want to get the economy roaring, but they don't want those very low rates to cause a bubble in the housing market. So how do you do that? Well, you need another instrument, and the other instrument is APRA and the macroprudential controls. So they've started to do that, and I think they'll probably do more. What we saw a few years ago was they imposed restrictions on investor lending. Investor lending couldn't grow by a certain amount. They made banks increased interest rates on investor lending separate to owner occupier. So you can see a few things happening to reduce the risk of a speculative bubble developing in the housing market. And I don't think it's going to stop house prices going up, but it may slow the speed of them going up. And you sort of take the edge off the market to some extent. But ultimately, with a recovering economy, interest rates staying low, it's hard to be, super bearish on the property market, given that backdrop.
Yeah, absolutely. I think the regulator just needs to make sure that we don't sabotage ourselves and the economic recovery that we're trying to orchestrate as well, because we need a stable property market to be able to do that and maintain consumer confidence as well. So, David, as always, we really appreciate your insights. Our team does, our clients do. Thanks for your time today. I know you're based up in Sydney, so you've got some freedoms coming back into your life. So hopefully you're enjoying them. I know you told me just before we jumped on the air that you had a haircut and went to the pub the other night. So looking great, and I'm glad to hear that you're enjoying yourself. And to our clients, if you've got any questions about your portfolio or markets generally at all, please reach out to your advisor. We look forward to seeing you soon and touching base with you again soon, David. Thank you.
No worries. Bye for now, Corey.
Thanks, David.